Good evening, ladies and gentlemen. I hope everyone is doing well. I hope everyone had a very happy New Year's Eve and a happy New Year's Day. I hope everyone is well rested and has enjoyed their holidays the past couple of weeks. We've had several new people join, and we're gonna give it just a few more minutes before we get started. I hope all of you guys have done well. Those of you guys who are new, welcome to Only Options Trades, and welcome to our very first lecture of the year. And I think it is apropos that we start our very first lecture of the year of 2024 and prior to the start of the trading year by getting our mindsets back into the right state of mind, right? Some of us maybe had some very, very good gains over 2023. And if you did, fantastic. I'm proud of you. And if you didn't, that's okay. Because 2024 is the start of a brand new year. It's the start of a brand new slate. It's the start of a brand new P&L. And so tomorrow you start from zero. Now that could be if you've had a great year, or that could be if you've had a bad year. Don't think those of you who've had a great year feel like, oh, this isn't applicable. No, it's even more applicable. Because if you had a great year that last year, that doesn't mean that you will this year. So we have to be in the right mindset, right? We have to be prepared for what the market's going to bring to us. If we didn't have such a great year, maybe we need to go back and see what we did wrong. And maybe if we had a great year, maybe it's time we refine some of those strategies and really hone in and bring those things to fruition that help us in our execution and get us to the next level. Ladies and gentlemen, I've been here for 3 years now, and I can promise you this much. I have seen traders come in and they have done exceptionally well and they have lost it all. And then I've also seen traders come in who have grown from zero to something much bigger than what they are. You too can be that, but it all starts with our minds. It all starts with how we perceive the market, and it all starts with how we execute against the market. So let's start 2024 off with a bang, and let's figure out exactly what we need to do to preserve our capital, to ensure our growth, and have one hell of a 2024. You guys ready? You guys ready to get started? I want to see some kind of excitement, guys. Put something in the chat. Tell me you're ready to get 2024's trading year started with a bang. Let's go. All right, guys. So let's start very simply here. We talked about the two types of traders in the past, right? Maybe in the past we've been trader A. How many of us have been there, right? Maybe in the past we felt we got up. We didn't really have a plan, but we saw the market was pumping, right? We saw some big news come out. Market had gapped up. Market's rallying, man. I feel like I want to go. I want to go and I want to get into some SPY calls. Well, market opens up, and the first thing I do is I jump into SPY calls, and I get that big fat rip, and I feel great, and I'm in up 30%, and I'm feeling all this euphoria. What do? I tend to jump into the next trade without any hesitation, without really having a plan, without really having a preparation. And so the moment I jump into that next trade, I'm immediately down. And now I'm not worried about the trade itself. I just see that, hey, I was up 30% earlier when I booked profits. Now I'm probably down to break even or maybe a little bit in the green. My emotions are driving my trade. And now I want to cut the trade, whether that trade's valid or not. We've all been there. Let's change that, right? We don't want those emotions to drive that trade. We want to be that disciplined trader. Right? We need to know what our rules are when we jump into a trade. What is our criteria for being in a trade? What is our profit target whilst in that trade? And what's our stop loss if it comes down to it? We want to be trader B, the trader who plans the trade out and is ready for execution. How many of you guys went into Toasty's tab earlier today and took a look at the PDF he put out? That is a wonderful PDF. And he's done a lot of the legwork for you. He's done a lot of the legwork for you. He's planned out or summarized several trades for you. Now it's up to you to go back and do what? Execute against the trade, right? We've planned the trade out. Fantastic, Scotty. I'm glad to see that you jumped in it. And those of you guys who haven't, I highly urge you to go take a look at his PDF. Go take a look at Tilio's PDF. Charts that are there for you to execute upon. Guys, nobody's going to walk you and hold your hand through it. Marcel, if you go into Toasty's tab as well as Tilio's tab, both of them have posted PDFs of weekly charts that they're looking at. I highly encourage you guys to do so. But here's the thing, guys. Nobody's going to hold your hand. They've given you charts. They've done the legwork for you. These are charts that are on their radars. Right? So what you have to do is now go the next step. And you say, hey, this is what the monthly levels are looking like. This is what are interesting levels on this particular chart, on this particular trade. I can now plan my trade out and wait for certain trigger criteria to jump in. And I know when that certain criteria fails, I'm out. Or when it reaches the next profit target, I can go ahead and take profits. But at this point, I am trying to be trader B. In order to be trader B, I have to have research done. Well, research is done for you here. And I'm not saying all the research is done, but a good amount of done is for you. Now you have to go in and execute, right? How do we let the trade actually play out once we execute? Well, we have to let the technicals and the plan dictate the trade, right? Because guys, once we're in the trade, we can't just back out because, oh man, I'm up, or oh man, I'm down. Oh man, I'm up, and oh man, I'm down is the way that we tend to lose money. We have to have a plan when we enter. And our plan is then dictated by the rules that are governed by it. And all of a sudden, you elevate. Think about it. How many times have you been in a trade and you were up 15, 20%, and you knew maybe it goes back to retest a certain level? And it does go back and retest that level. And you wish that you had taken out that 15%, but you didn't. Well, sure enough, you get a bounce right off of that level, off of that EMA, whatever your level was. And the only reason you decided to take it off at that level of support there is because that's where you had your stop loss at. And you see that bounce to the next level. Well, you never took a re-entry, and you've seen it run against you. More often than not, you're letting your emotions govern it. Or it's because you didn't really have a trade execution plan around it. A lot of times we think we have a trade execution plan when we really don't. Think about it. How many of you guys are jumping into a trade based off of the 5-minute chart, based off of what you see right then and there? How many of you are using hourly levels based off of a 5-minute chart? Do you have a governed strategy built out with the trade? Have we determined, is this a day trade? Have we determined if this is a scalp? Have we determined if this is a swing? More often than not, we just see profits and we book them. And again, I'm not opposed to booking profits, ladies and gentlemen. But I want us to elevate. I want us to get to the next level. The only way to get to the next level is to plan your trade out and then execute against your plan. Plan your trade, trade your plan. This is something I've been saying and preaching for the past 3 years in here. And it's something I'll continue to say for as long as I'm here. Plan your trade and trade your plan. How many of us go into the trading day based off of a plan? Some of us say, hey, I like this daily level on XYZ ticker. And a bounce here looks really good for a move. And so you enter into a trade based with time, only to take off 5 or 7% off of a trade based off of a micro move. I want us to start looking at trends, right? And again, many times we're doing this off of daily levels, weekly levels, longer time frame levels, but we're trying to take trades off and on off of these shorter time frames to execute against, but using higher time frame levels. There's nothing wrong in doing so, but I want us to start defining our strategy along with trading our plan. When we plan our trade out and we say, hey, I like a break and retest of XYZ level, am I planning to hold this for a quick scalp, for a quick 60-cent move? Maybe the next hourly level above is 75 cents above. Maybe we can get that in one candle sometimes, right? So maybe this is a quick scalp. Have I defined that ahead of time? Maybe this is, I'm looking for a broader move. Maybe I'm looking for a more, a broader $2, $3 move that I'm not necessarily going to get even in a day, but I'm expecting it when I take the trade because, hey, it broke my level. I want us to start defining the strategy. So along with planning your trade plan should include, hey, this is my entry. Based off of my entry, this is my stop loss. Based off of my stop loss, this is my take profits. But along with all of this, I am anticipating that a break of this key level on increasing volume will allow me to get X amount on a quick scalp. Versus if I have to hold this longer for a broader move, will I get that in a day trade? Will I get that in a swing trade? Will I have to hold this for multiple days to get this? More often than not, we all plan the trade, but we don't plan the strategy for the trade. How many of you is this applicable to? How many of you enter a trade thinking you're going to day trade or thinking you're going to scalp and end up jumping into a day trade? And now you're justifying your trade along the way. You got in based off of that 9 EMA bounce on the 5, and because it didn't bounce and you didn't stop out because you didn't really have a true stop loss, now you're trying to justify the trade along the way. How many of this is this applicable to? We don't define the trade plan right from the get-go. If it's a scalp, it's a scalp. And so if I break that level, I'm out of the trade and I have to be comfortable with it. And I have to respect it. But more often than not, we don't do that because we don't define our strategy right from the very beginning. So what makes a trade a good trade? Let's plan that trade out. Let's first define the strategy and say, hey, I want to do this as a quick scalp off the 5, or I want to do this off a day trade off of the 15, and I'm waiting for a 15-minute close. But let's define our reasons why this is a good trade, and let's define at least 5 good reasons. Oh, I've got certain indicators that are telling me this. I've got an increasing amount of volume. Oh, I've got a major level of support. Oh, I've got a major level of resistance below. Or a level of support that, or a level of resistance that's turned into support. Whatever my characteristics are for what makes that trade a good trade, I should be able to write them down. Not a matter of just being able to speak them, because it's very easy to justify a trade while we are in it. I'm talking about in advance of the trade, what makes this trade look good? And am I able to write it down? And guys, I'm not saying that if you're planning to be in 5-minute scalps, that you should write down every one of your trade plans. No. But if you're struggling with your trading and you're having a hard time understanding and reading price action, write down 5 reasons for why you want to enter that trade. And then give me 2 reasons why this could turn to shit. And I guarantee you, when you start to do that, you'll start to dissect truly what your strategy is. If you don't have a defined strategy yet, start building your strategy. And if you do have a strategy, then you're already determining what your 5 points are. But we're trying, again, to elevate our trading, right? So if you're already reading price action well, and you're able to go ahead and take that trade, and you know what your stop losses are, if you're finding yourself in a position of, hey, I'm taking my profits too early, ask yourself, am I really staying in this trade based off of the strategy I defined? Because more often than not, that's where we find ourselves in lacking. So now that we've planned our trade out, right? Now we've defined, hey, this is our reasons of why I'm in this trade, or why I like this trade, and why I'm going to take this trade. Now I should try to work on my execution. Yeah, Fernando, once I finish this, I'll get one of the other analysts to post it in their tab. So now I want to figure out my execution plan, right? Think of this as a business, right? If I have a business that I'm working on, then it's all well and good to have a plan, right? Plans are great, but I still have to execute against it, right? It's all great to say theoretically everything should work out like this, this, and this, but now I have to execute. And our execution around our trades is dependent upon us following the plan. And in order to do that, we have to look at the option contracts in advance. And you don't have to do this a week in advance. You can do this even 5 minutes in advance. But if you now know that, hey, I am planning to day trade particular contract off of the 15-minute or higher time frame, I'm expecting a broader move, and I have looked at the option contract, and I have seen what delta value will allow me to get to the profit target that I want to see. And based off of the entry level that I have, what my option contract should look like. I now have already created a position where there's going to be minimal loss. Because again, if I've looked at this in advance, if I'm executing this, and I've looked at this in advance, and I say, hey, I like Microsoft 280 calls on a break over 275 as an example, and I like the Microsoft 280 calls for next week, and let's say they're trading right now at $4, but at 375, they would be trading, let's say, at 364 or 365 a contract. Based off of the delta value, I can position myself in a way where when that contract, or when Microsoft gets to my level, I'm prepared with that option contract, so that when it breaks my level, I can execute. And the moment I execute, I wait. Because now I know that a break below this level that I had tried to jump into is the level that I want to get in on, but I'm expecting a broader move. So I have to wait on my candle close, or I have to wait on my trigger that's going to say, hey, this is no longer a viable trade. And if I get in that trade, then the moment that it gives me profit, I can either make a decision to move my stops up, or I can allow that trade to get to where I want it to go to. Sometimes that's going to mean that you're going to stop out earlier than you want to. Sometimes that's going to mean that you're going to stop out in a position that you don't necessarily want to. But sometimes you're going to have to read that price action in a way that allows you to follow your trading plan, and allows you to follow your entry, your exit, and your stop loss based off of the profit targets that you currently have. Everyone with me so far? Are we all on the same page? Everyone good with planning our trade and trading our plan? We feeling good so far? We feeling ready for 2024? Good. So next, stop losses. Oh, I love stop losses. Love stop losses. I love stop losses because most people don't like to use stop losses, and most people like to believe that they have a mental stop loss, and they're very good at it. I'll be honest with you. The best traders use mental stop losses and it fucks with their head. I'm not ever going to mention any names, but even the best traders use mental stop losses and it fucks with their head. And I'm not even talking about traders in here. I'm talking about multi-million-dollar traders. Stop losses save portfolios for a reason. It's because when you break a key level and you know that your trade plan has said that this is a key level, then more often than not, your gut is telling you this trade is no longer viable. Yes. Can the trade bounce back? Absolutely it can. Absolutely it can. Sometimes you get another re-entry. Sometimes you just have to expect the L and move on. But your stop loss will save you 9 times out of 10. 9 times out of 10. Your stop loss is by far the most important aspect of your trade, in my personal opinion. Because once your key level is broken, your trade plan has dictated that that trade is no longer viable. And the only reason you're sticking around in that trade is now you've found enough excuses and enough justifications to say this is still a viable trade. But you're fighting against your gut the whole way. Think about every loss that you've taken, every big loss that you've taken, I should say. I don't want to say every loss. Think about every big loss that you've taken. Every big loss you've taken, you know that you should have stopped out of way earlier. But what did you do? You held it. You may have doubled into it. But more often than not, your gut told you this thing has gone to shit and I should have stopped out a minute ago. But you don't. And those stops are what destroy your portfolio. Because if you have a 20% stop loss or a 20% mental stop loss on a trade, depending on your position size and your portfolio size, that 20% could make or break your portfolio. And that 20%, when doubled, could destroy your portfolio. I see it all the time. I see people with $5,000 portfolios put $1,500 into a particular trade saying that, hey, I've got a mental stop loss at 15%. And when they're down 15%, they can't really handle a $750 loss. Right? So now they're trying to hold, or sorry, a $250 loss. And so now they're trying to hold on to that trade longer. And they say, hey, you know what? This is a really, really good level of support. Let me double in. And they double down onto a position rather than stopping out when they should have. They don't want to accept the loss. Guys, there are so many various stop losses that you can utilize in your trading. And every single one of them saves your portfolio. Stop losses are not designed to just take out targets for no reason. Yeah, there are stop hunts. Absolutely there are. There are liquidity grabs. Absolutely there are. But they're there in order so that the stock can continue higher. But that means you can always get another reentry. But if stop is there, then what's the worst that's going to happen? Either you get stopped out for a small loss, or you get stopped out at a small profit, or you get stopped out at a big profit. But a stop loss is only going to prevent a big loss, right? That's the only thing we have to avoid as traders. That's the secret. Anybody who's an options trader will tell you the key to being successful in options trading is to avoid big losses. Because guys, you get small wins, you get big wins, and it's okay to take small losses. That's the secret. It's okay to take small losses. We just can't take big ones. Stop losses is what's going to make that happen. So you can use a stop limit or stop market where, hey, if it breaks that key level, I stop out. Boom, I'm out, no matter what. I can use a trailing stop, especially for those of you who are Thinkorswim, as that contract continues to rip higher, your trailing stop moves higher with it. And the peak of that option contract is the peak where your trailing stop will stop from. If I have a 10% from the peak of the contract, then the 10% from there is where it'll stop me out at. I can use OCO orders where I have a take profit and a stop out. But guys, stop losses is what's going to allow me and dictate whether or not that trade that I'm in is still a viable trade and whether or not my profit is at further risk of deterioration or not. Which leads us to the very next point, risk over reward, right? How many of us are thinking about risk over reward? I want us to start thinking in terms of risk over reward. When you dump $500 or $800 or $1,000 into a position, how much are you risking? Because the truthful and honest answer is you're risking 100% of it. If you're not using a stop loss, you're risking 100% of it. And that, my friends, is not trading. That is gambling. When you are risking every dollar that you put into a trade without a stop loss, you are saying, I'm risking every dollar I have in this trade in order to make a couple of dollars. I love blindly gambling. Hey, go to Vegas, bro. You probably have a better chance in the options market. I promise you. But that's the facts. And guys, we need to be traders here. We can't be gamblers. I know we like to gamble, and that's why we take lottos. Shit, it's always fun to take a 20-cent SPX contract and see it go to $5, but it doesn't happen often. And that's like hitting it on the roulette table. So rather than doing that, I want us to say, hey, if I'm entering $1,000 into a position, how much am I willing to afford to risk? Because $1,000 position into a particular position or a particular trade, you may only determine that I'm going to risk $200 of that money. That's only 20%. And if that's the trade that you want to do, and you only want to risk 20% of your money, what does that mean? That means you have to have a very solid trading plan so that your stop loss doesn't stop you out, right? And that's the way to think about it. If you have a stop loss and you want to define your stop loss by a percentage or a value, that's fine. But I want you guys to start thinking about risk and reward regardless of where your stops are. Your stops can determine your risk. And that's the way I highly recommend a lot of people to start off thinking. But when you start thinking that way and you continue thinking that way, Caleb, it can digress into being focused solely on P&L. And I don't want you to do that. Is stop limit the same as stop loss? Yes, James, a stop limit is in essence the same as a stop loss. However, what I understand with Robinhood, and I have used Robinhood myself, is if you are in a trade that has a wide bid and ask, in Robinhood, your stop limit can be skipped. So you have to be very careful with Robinhood, especially with various contracts that have wider bid and ask spreads, because it can skip for things like that. That's why, and I'll always recommend get off of Robinhood, man. It's really, really easy to open up a Charles Schwab account and open up an account in Thinkorswim. And trust me, your life will be that much easier. But again, I don't care about the charting features here, guys. It's not about Thinkorswim because I love the charting or about, the faster fills or the better executions and, all around Thinkorswim is a better platform. But that's besides the point. It's the very, very simple reason of your stop loss options. Guys, capital preservation is number one for us as options traders. As traders in general, if we don't have capital, we're not going to trade because money is not infinite. Money is finite, right? And there is only a certain amount of money that you are going to put into your education as an options trader. Many of us have put several thousands of dollars before we saw profitability. The question here is, how much are you willing to dedicate to this, right? And with a proper stop loss, it ensures that at least you minimize your losses or reduce your losses as much as you can while you learn what your strategy and your edge is in the market. So we good with stop losses. Stop losses, safe portfolios. I said this to Toasty the very, very first time I ever met him. And it's something I still we still talk about. The very first thing I said to Toasty when I first met him is, well, not the first thing, but in our conversation, or one of our first conversations, we started talking about our trading attributes, and I asked him about his stop losses, and he said, "Oh, I don't use a stop loss, or I don't use a trailing stop loss." And I told him that if you're not, then you're doing a disservice to yourself, a disservice to your trading. Stop losses save your portfolios, and if you're not going to use them, trust me, it will make your trading that much more difficult. Moving on. Risk over reward. So we talked about this briefly, right? We started talking about how we want to start moving our mindset to risk over reward. I want us to start thinking about how much money am I risking in a trade versus how much money am I potentially going to make in a trade, right? Now, that's within a trade itself. But part of this, especially the aspect that goes beyond our psychology, is understanding our risk over reward of our portfolio. Now, there is certain tips and tricks or certain rules of the trade that we tend to use, right? You shouldn't use more than 10% of your portfolio in any particular trade. You shouldn't have more than 2 to 3 trades open at any given time. And at any given point in time, you should always ask yourself, how much can I lose, not how much can I make, right? That's the very simple basics around risking or understanding our risk over reward. But we find ourselves doing it far more often than you realize. How many times have you said, "Hey, I'm feeling really bullish and I like SPY calls right now," and you jump into some SPY calls, but you're not necessarily looking for a move right now. You may be looking for a move later in the day, and so you're not getting same days. Maybe you get the next days. And then along with that, NVIDIA is looking really bullish right here, man. I think we might get a move out of this consolidation. So you're in NVIDIA calls as well. They know you're in this calls as well. Then before you realize it, you're in 3 or 4 trades. And you're not realizing it, but you're jumping into all of these trades simultaneously, and you're putting roughly the same amount of money in it. And you're not realizing it because your only thought is, I think it's going to go up. I think it's about to make that move. I think I'm about to potentially make money. You're putting $500, $800, $1,000 into a particular trade. And if it makes us money, fantastic. We're feeling great. But we don't focus on how much can I potentially lose. Because if I do take on those 3 trades and I do put $1,000 into each position, and I do this intentionally or unknowingly, intentionally, and I don't get the move that I want, or we get some kind of news and we get a break to the bounce side, I have no longer have focused on my trading portfolio. I've just been thinking about individual trades. And when that drop finally does happen, and I see my portfolio go down 300, 300, 300 on 3 particular trades that I had $1,000 a piece in, I'm down $1,000 all in one shot. So risk over reward isn't just about risk over reward in a particular trade. It's risk over reward in your entire portfolio. How do I really narrow my risk over reward over my entire portfolio? Well, that goes to the next step that many have asked in the past, which is my position sizing. Position sizing is always a relative question, right? It's a relative question. Oh, how much should I put in a particular trade? Well, option contracts are so expensive for a particular stock. How much? It's all relative. But what I have found is that when you feel like you're too heavy in a particular trade, you feel the movements, every micro move, you feel it in your heart, you're too heavy in that trade. Ask yourselves, ladies and gentlemen, how many times have you been in a trade and SPY makes a 30-cent move and your heart is fluttering, seeing exactly how much profit you might see, or a 30-cent to the downside and your heart is fluttering, how much am I down? You're too heavy. If I'm in a trade and I have to watch it constantly, I'm in too heavy. Because remember, if we have already followed what we talked about on the first two slides, I had a trade plan when I entered, right? So I planned my trade out initially. I executed against my trade plan. I'm waiting currently based off of my trade plan for a move to the upside or to the downside. I have my stop loss in place, so all my fear is gone. I shouldn't be worried about how much money I'm going to lose. My profit targets are in possession. And so I know, what price my contract should be at when I should potentially reach my profit target. So the only thing that's really changing or governing any emotions within this trade is my position size, is my P&L. Caleb, this goes back to what you and I were talking about just briefly. Remember how you said that you just try to determine your stop loss based off of your percentage and how much money you're going to risk. That's fantastic when you're doing it at one contract or two contracts. But let's start elevating our mindset to a bigger scale, right? I don't want to just play the onesie twosies. I want to start scaling with enough money into a contract where I could feel profitable, right? So if I dedicate a certain amount into a particular trade, but I tend to find myself concerned with the micro movements with the underlying stock because I'm focused more on the option contract, then I'm in too heavy and I need to deleverage myself. I need to de-risk the position. Get yourself in a position where you can take a certain dollar amount of that position in any particular contract. And it doesn't bother you one way or the other when you have your stop loss and your take profit in place. Well, I'll make sure the stop loss is at a level where trade is considered invalid. Like sometimes I'll catch a put at the top and it's reasonable for my stop loss to be 8%. Is that dumb? No, not at all, Caleb. And I don't want to try to say, hey, where you place your stop loss, Caleb, is where you feel comfortable. And however your trading rules are and allow you to be profitable, that's the successful route for you. I don't want to try to dictate you one way or the other. But what I want to try to say is, if you're okay with your stop loss being at 8%, regardless of your position sizing, then it's not stupid, or it's not a dumb thing to do, or it's not an irrational thing to do. It's only if your position sizing is greater than a certain value that, hey, if my normally would have my stop loss at an 8% or 10% or 20%, that now I'm trying to move my stop loss up and down one way or the other because I'm too emotionally vested in the trade, is when it becomes an issue of your emotions dictating the trade versus the validity of the trade itself. Does that help, Caleb? Awesome. So, risk over reward. How much am I going to make? That's always a relative amount. But how much am I going to lose? That's something I want to keep as a key factor in the back of my head. And again, the reason for this is very simple, right? And all of this has been very simple. What have we done thus far? We've planned to trade out. We've created an execution plan against it. We've got a stop loss that prevents any or mitigates any major losses. And we've determined that, hey, how much we make is relative versus how much can I lose. And all of this I'm doing in order to preserve my capital. Last but not least, and I'm going to talk about this very, very briefly, because I know as options traders, we may not necessarily talk about diversification much, but I think it's just as important to talk about diversification with respect to taking profits as it is with having stop losses. As an option trader, you may not just day trade. You may not just scalp. You may take swing trades. You may have a long-term portfolio. And in those situations, I will highly urge you that you should always hedge and diversify your portfolio. If you are solely an options trader, you should be paying yourself with some sort of dividends, whether that be through a paycheck or whether that be through buying stock of good companies for your long-term portfolio. But whatever your options strategy is, as an options trader, we have to diversify. And diversification doesn't necessarily always just mean buying stock, but it does mean that we have to ensure that we don't always leverage heavily into one particular sector. Don't over leverage heavily into anyone's particular sector at any given point in time. That's as an options trader or as a long-term investor. If you are a heavy long-term investor in, let's say, QQQ for your long-term portfolio, and we see that we are at the highs, it may not hurt you to say, hey, maybe I use derivatives like options to help hedge my portfolio in a situation like this. Maybe I can buy shares of inverse ETFs to hedge my portfolio. Maybe I can use derivatives in order to further give myself an edge in this market. Guys, at the end of the day, we have to be traders along with investors. Guys, at the end of the day, options trading is still an active form of trading. It's still an active form of money. I want to get us to the point where we're passively making money. And passively making money means long-term investments. And that means not timing the market, but time in the market. But that doesn't mean that we don't diversify. It doesn't mean that we just put all of our eggs in one basket. We have to hedge our portfolios. If you're an options trader and you're heavy in bullish positions, even if they're for a shorter duration, but a longer time frame, let's say they're 30 days out, 60 days out options, you're heavy in bullish position, it won't hurt you to have an insurance policy. Guys, every single one of us buys a house. What's the first thing you do? You buy home insurance. You buy a car. What's the first thing the bank makes you do? You buy a house or your car insurance. Hell, what's the biggest reason for bankruptcy in the United States? It's healthcare, right? Because many of us can't afford health insurance, considering what the health premiums are looking like. Insurance is there just for protection. That's what your hedge does. So always hedge yourself in order to protect your portfolios. If you're not swinging positions, then maybe you don't need them. But always consider them to hedge yourself in a position and find yourself in a position where you're profitable regardless of whatever your portfolio, whatever the situation may be. So that brings us to our last and final slide, and that's our summary slide. Everything we've talked about today has been very simple, and these are all very simple tips and tricks to bring your mindset to a very positive state of mind as we start our trading journey in 2024. But the first and foremost thing that I want you guys to take away from tonight is plan your trade and trade your plan. Plan your trade. Planning goes a very, very, very long way, ladies and gentlemen. 1% growth per day is all we can ask for. Plan your trade out and trade your plan and see if that doesn't make a difference in 2024 with your trading. Use your stop loss. Prepare to take those losses. Because, guys, small losses don't hurt. Small losses don't hurt because one big good win can knock out all of the small losses. But one big loss can hurt deeply. Don't let one big loss turn your psyche into shit. Always use a stop loss and use that trailing stop loss, especially when you're happy with your profits, but you just want to see if that contract keeps running. But use those stops. Those stops are in play for a reason. Preserve your capital, ladies and gentlemen. Understand your risk before you expect that reward. We're all wanting to make money here, guys. That's why we do what we do. Not a single one of us is in here because we want to lose money. Not a single one of us takes a trade because we're hoping that we lose money. We all want to earn money here, but we have to know what we're willing to risk in order to be profitable. It's very, very, very easy to say, I want to make money. It's really, really hard to say, hey, I don't want to lose more than this. Because when it gets down to that level, you may say, hey, I think we might see a bounce, or hey, I think we might see a pullback here. Don't be a hoper. Hopium is the worst drug for a trader. Understand your risk, know your reward, and be prepared to take that loss when you're at that level of risk. Stay hedged at all times. Staying hedged and diversification of your portfolio will ensure long-term growth in this business, not in this game, in this business, because that's what we are in. This is not a trip to Vegas. We are not gamblers. We are traders. We find profitability in probabilities, and we ensure that we have an edge to ensure that we have skewed the probabilities in our favor for profitability. Last but not least, pay yourselves, ladies and gentlemen. I love people who say, man, I've seen $100,000 growth in my portfolio this year, and they have never taken a single dollar out of that portfolio. Because in my opinion, not a single dollar has been made. It's not made until it's moved. And it doesn't have to be moved into your bank account. It doesn't have to be in cash. It could be into long-term portfolio. It could be into dividend growth. It could be into long-term stocks. It could be into a brand new car. It could be into real estate. I don't give a damn where you move your money. But I really, really, really want you all to know that you are not a trader until you pay yourself. That is the reason, James, why I believe in the cash envelope. I have been doing the cash envelope for many, many years. And it's a very, very simple strategy. I keep $1,000 in cash in my desk. And the only reason I do that is because we have become so desensitized to money. Everything's on your screen. Everything is, it's just on your phone. Hell, we don't even get checks anymore. You don't get everything is direct deposit. Your job pays you, and you don't get a check. You don't get cash. It just goes from their bank to your bank, right? And you just see a few more numbers on the screen, and then you got to pay your bills, and so you just see a few numbers leave your screen, and then you look at your trading portfolio, and you see numbers going up and down on your screen. And then you go to spend money at the grocery store or to buy yourself something, and you swipe your credit card, and it's again numbers on a screen. And so we've forgotten what the value of money has become. And we tend to take advantage as options traders, especially the amount of leverage that we take on as options traders. We have the potential to make a lot of money in a very short span of time. Think about it, guys. I've seen some of us make $1,000 in a matter of 5 minutes. Seen it in the gains tab. That is very special. It's a very special thing to be able to do. And many of us don't even realize the value of that. But when I pull out my envelope and I pull out, hey, I made $700 today, or hey, I lost $250 today, and I realize what $700 is, or when I realize $250 is, and what that can buy me or what I can lose with that money, it hits home. And that is a feeling that keeps you grounded. I've been trading for several years. I've been profitable. I've done very well. And yet I still do this because it grounds me. It helps me keep in touch with, hey, how much money am I actually making, or how much money am I actually losing? Because that's the way I pay myself. And it all boils down to capital preservation, ladies and gentlemen. Because as a trader, even if I take a loss and I take another loss and I take another loss and I take another loss, I can come back the next day and trade again. And I can come back the next day and I can trade again and again and again and again. But if I blow my portfolio, there's no more trading. That's it. Game over. Call bankruptcy. That's what happens when a business shuts down, right? Declare bankruptcy, you call it a day. Move on. You don't just throw more money into your trading account when a business shuts down. When a business shuts down, it shuts down. Shuts stores down. Treat it like a business, ladies and gentlemen. It's about capital preservation. Live to trade another day. That's what matters here. We all want to make money, but the secret to being a successful trader, and the secret to being a successful trader in 2024, live to trade another day. Know that, hey, if I've got a portfolio, I can keep trading. So let me minimize my risks. Let me plan everything accordingly. Let me have stop losses in place and be ready for success. Any questions before we call it a night? No questions? Okay. All right, guys. Oh, I love it when you're here, Kevlar. I'm happy to do it, Caleb. You know, Kevin, we all need to let our winners run better. You know, and that's and here's the thing, Kevin. Winners will always run when you allow them to run. See, here's the thing, guys, and this is another trick, right? When you start scaling, you can take 10, 15, 20, 30 percenters and be happy with it and allow your runners to run because you've already taken enough profits where you are in very little risk, right? So letting your runners run can happen, but you have to let runners run. Don't think for a second that if you take $1,000 position and you've taken $250 off, or let's say you've taken a $500 or $250 or $300 position in a trade and you took off, $100 off of that trade, that you're letting runners run. Those aren't runners. You're still heavily in the trade. A runner is once you've pretty much have paid off the trade. That's what a runner is, Kevin. So again, let's remember, what did we say? The very first thing, how do we elevate our trading? We've got to define our strategy. We only have a runner if we've already paid off the rest of our contracts. That's when you can let those runners run. No, and guys, thank you for being here. I really hope this was a great lecture for you guys. I really hope it helps us get into the right frame of mind. 2024 is going to be one hell of a year. It has been a phenomenal year in 2023 for only options trades. I know that this is only going to be a year that gets better for us. Guys, I'm always around. Reach out to me. Any questions you have, charts you want to go over, any trading plans, I'm happy to help. All righty, guys. With that said, please reach out. I hope you guys have a great rest of the night. I hope you have a great week. Let's start off 2024 in the green. We'll talk again soon. Have a great weekend, and we'll talk later. Bye-bye, all.